Are you still stuck on where do I even start investing? Inflation's eating your savings alive and waiting feels safe, but it's not. Stick around, I'll make this dead simple. Have you ever looked at your savings and thought, I've worked so hard for this money? Now what? You've done the difficult part already. You worked hard for your money, long hours, overtime, maybe even side gigs. You saved it smartly, built an emergency fund with 3 to 6 months expenses covered, planned for holidays, surprises, and festive spending. Smart moves all around. A rule of thumb is to have a saving for at least 3 months if you are alone and 6 months if you have a partner or family. But here's the uncomfortable truth most people ignore. Money sitting in a savings account feels safe, but it's quietly losing value every year to inflation. Right now, even the best easy access savings accounts are paying around 4 to 5%, while inflation is eating away at about 2.7% of your purchasing power. On the surface, you're ahead, but after tax on interest for many people and real-world price rises, that growth often barely keeps up or even falls behind. There are so many investment options out there like stocks, property, crypto, gold, index funds, businesses, and it can feel overwhelming. You might be thinking, I don't want to risk my hard-earned cash. I don't want to gamble. Where do I even start? That's exactly why I'm here. Today I'm breaking it down simply: why you should invest, where to put your money, mistakes to avoid, and how to start safely with something like $5,000 with no expertise needed, no high-stakes gambling. Let's start with why invest at all. Savings accounts are essential for emergencies, but they're not built for growing wealth long term. As most standard ones pay very little, and even top easy access rates around 4 to 5% get eroded by inflation and taxes. Imagine putting $5,000 in a savings account today. It grows slowly. Now compare that to the same $5,000 in a diversified portfolio historically averaging around 7 to 10% annually, like broad stock market index funds over 10 to 20 years. The gap is huge. You're potentially leaving thousands on the table by doing nothing. Inflation is the silent thief. Prices rise, groceries, energy, rent, and your money buys less over time even if the balance looks bigger. Investing aims to grow your money faster than inflation, preserving and increasing your real buying power. Then there's compounding. The magic where your returns earn returns on themselves. It starts slow, almost boring, but explodes over time. Invest starting from $5,000 at a realistic 8% average annual return. After 10 years, it's grown nicely. After 20, it's transformative. Time in the market beats timing the market every time. When people hear investing, they picture risky bets, crypto crashes, meme stocks, day trading, or over-leveraged property. Yes, those exist, but they're not for beginners. Property can build wealth through rent and appreciation, but realistically, small amount isn't enough for a deposit, mortgage, maintenance, or taxes. It's a bigger commitment later on. Crypto offers big upside potential but extreme volatility. You can lose a lot fast. It's more speculation than solid investing for newcomers. The stock market is where most everyday people can start realistically. Buying stocks means owning tiny pieces of real companies. As they grow and profit, you benefit through rising share prices and often dividends, cash paid just for holding. But picking individual stocks is tough. Even pros get it wrong. Warren Buffett advises most people to avoid stock picking and go for low-cost index funds instead. So now the common question is where to invest to reduce risk. This is where something like the S&P 500 index fund comes in. It represents the 500 largest companies in the US economy. You're not betting on one company, you're betting on global economic growth over time, diversified. Low risk compared to singles, and historically reliable. To get started, use a beginner-friendly platform depending on your preferences. They're simple. Open an account, often in a tax-free stocks and shares, choose a fund, invest your money, and let time work. Many platforms allow starting with small amounts and regular contributions. If you have more money to invest, you can add diversification. A bit in gold for protection during downturns, REITs for property exposure without buying bricks, or small tech or AI funds for growth potential, always keeping risk in mind. Now let's talk about mistakes because this is where most beginners fail. The first mistake is procrastination. Waiting for the perfect time almost always costs you money. Every year you delay is a year of compounding, lost forever. The second mistake is panic selling. Markets go up and down. That's normal. New investors see a drop and sell at a loss, locking in damage that could have recovered if they simply stayed invested. And the third mistake is lack of diversification, putting all your money into one stock, one sector, or one idea, especially when you are a beginner. That is why index stocks and diversification is suggested. This approach is the slow lane, steady, boring, but proven to build real wealth over time. But honestly, for most people, the slow lane alone isn't enough if you want financial freedom faster. You need a fast lane too, boosting income, skills, side businesses, or scalable ideas. Higher risk, higher reward, and that's what we'll cover in the next video. So if you've got $5,000 sitting idle or any surplus beyond emergencies, don't let inflation chip away at it. Start smart, diversify, be patient, use a simple platform, and index funds. And let compounding build for you. If this helped, like the video, subscribe for more, and comment below. What would you invest in first? See you in the next one.